Have you ever wondered how the financial transactions of a business are recorded and tracked? It's through a process known as journalizing, a fundamental aspect of accounting. Today, we delve into the heart of journalizing, breaking it down into comprehensible steps and summarizing the key points. Picture a ledger as a library, and journalizing as the librarian who ensures each book, or in this case transaction, finds its rightful place. From the smallest purchase to the largest investment, every financial move of a business gets recorded in a journal. Firstly, journalizing begins with identifying the transaction. This could be anything that involves the exchange of value, such as buying office supplies, selling goods, or paying salaries. Each transaction has a financial impact on the business, altering its financial position. Next, the identified transaction is analyzed to determine the accounts it affects. An account can be anything from cash, accounts receivable, inventory, to accounts payable, sales, and owner's equity. The transaction could affect one or more of these accounts. Thirdly, the transaction is recorded in the journal in chronological order. This chronological recording is what gives the journal its other name, the Book of Original Entry. The date of the transaction, the account names, the debit and credit amounts, and a brief description of the transaction are all recorded. Now, it's important to remember that every journal entry must obey the principle of double entry bookkeeping. This means for every debit entry, there must be an equivalent credit entry. The transaction affects at least two accounts, with at least one account debited and another credited. Once the journal entry is recorded, it's then posted to the respective ledger accounts. This is the final step of journalizing, where the transactions leave the book of original entry and find their place in the respective ledger accounts, the so-called books of final entry. To summarize, journalizing is a systematic method of recording and classifying business transactions. It's a five-step process involving identifying the transaction, analyzing the accounts affected, recording the transaction in the journal, ensuring the principle of double entry bookkeeping, and finally, posting the journal entry to the ledger accounts. Journalizing is the backbone of accounting, providing a detailed record of all financial transactions of a business. It ensures transparency, facilitates analysis, and aids in financial decision-making. So, the next time you see a financial statement, remember the meticulous process of journalizing that lies behind it. Journalizing may seem like a complex task, but with understanding and practice, it becomes a fundamental tool for any aspiring accountant. Remember, every transaction tells a story, and journalizing is the way to tell it accurately. It's the art of painting a financial picture, one transaction at a time.